Patrick Delhougne, and I'm delighted to start this YouTube program, the Patrick Delhougne Show, that will cover your money, global macroeconomic issue, real estate investment, and human capital trends. I really feel the urge to provide such coverage right now, as we are now facing a very serious economic situation with various economic challenges that will directly affect your money and your saving. I want this program to provide you with some overview of what's happening in the economy, and more importantly, what you can do to improve your financial situation. So episode number 1 will be based on the banking system. And my thesis here is that the banking system is really falling apart because of major solvency issues. So let me start. And what we have noticed is that hundreds of banks are facing very serious solvency issue. And this in the amount of hundreds of billions of unrealized losses. And there was an article in the Wall Street Journal at the beginning of this week speaking specifically about that. They are really threatening to trigger the next big liquidity crisis for all the banks in the US banking sector. But this is a problem not only in the US but also globally. We just saw a very serious liquidity crisis with Silicon Valley Bank and Republic Bank that had to be bailed out by the US government. We saw the Treasury putting more than $300 billion last week to support the banking system. So this is not business as usual. We understand that when the Treasury was trying to really tighten their money printing and reduce it to a very low number, the fact that the Treasury came back and put $300 billion to support our banking system is not a normal event. But at this time, I'm afraid to say that there is no amount of money that can be printed by all the different agencies to fill this huge hole created by unrealized losses. So it really created a serious risk to create basically more bank runs. Banks are upside down on their mortgage-backed securities and long-term bonds. And they have purchased over the past year. So with a low yield return on the long-term bonds and decline in loan book value. So what we see here is that the value of all these loans must be measured at today's fair market value. So in no other term, they are really upside down because the value of this loan has dramatically decreased, and it has decreased by a range of 30 to 50%. The top 435 publicly traded banks in the US have more than $242 billion of unrealized losses on these loans. So it is not surprising to see bank portfolio decreasing in total value, and also that regional and small and medium-sized banks have a more serious problem. Mega banks have large unrealized losses, with Wells Fargo at around $41.5 billion, JP Morgan at $36.6 billion, and Citi at $25 billion. And you can see this on the chart here. So this is the unrealized loss problem is not only concentrated to the small and regional bank. Our mega banks, so the big four banks, the chart shows you that the big four net unrealized losses is also considerable. As a result, we've seen Moody Investor Services, which is a rating agency, cut their outlook for the entire US banking system and place 6 US banks on review for potential credit rating downgrades. So this happened 2 weeks ago after the first wave of the banking crisis and the failure of Silicon Valley Bank and Republic Bank. So basically, the credit rating firms said that they expect more banks to continue to fail, and particularly those with large holders of uninsured deposit and long-term treasury bonds that have crumbled in value. Moody's said that they expect pressure on the banking sector to persist as the Fed continued to hike interest rate to combat inflation. And we saw last week the Fed increasing their rate by 25 basis points, which continue to put further pressure on the entire banking system. And what we need to also notice here is that this is not only a problem in the US economy. We saw the Swiss government last week working over the weekend and convincing UBS to purchase Credit Suisse for a value of around $3 billion. And this is quite surprising in the sense that the fair market value of that bank was estimated to be around $8.5 billion, but you need to take into account the unrealized losses. So you can see that if there is a bank run on a bank and the bank doesn't have enough liquidity, even if on their balance sheets the unrealized losses are there and they've been unrealized, so the moment they become realized, you really have way too much leverage on the bank to survive. And the next thing you know, bank could be in major troubles as they could see more runs on the deposit, which is the logic thing to happen. The problem is further exacerbated as banks have started tightening their loan policy and they are lending less, much less. On top of that, they continue to face competition from the Fed that is now offering 4.8% for the overnight reverse repo rate. And this is problematic because as banks should be trying to increase their deposit with quality loans, the prospect of recession and a major international slowdown on the economy has bankers really assessing the risk differently. And in addition, the risk that depositors are not trusting their small and medium-sized bank has dramatically increased. So the first wave of the bank crisis with Silicon Valley Bank and First Republic has really created a flight to security. This is the reason why we've seen more bank runs as depositors are moving some of their holding to mega banks. We are talking about the JP Morgan of the world, the Chase, Wells Fargo, Bank of America. This is what people commonly refer to big mega banks. In addition, many of these banks are facing another issue. Keeping interest rate to zero is becoming untenable, as many investors are now looking for safe and higher return alternatives. As we know, after the pandemic, mega banks received very large amount of the deposit, and they did not want to keep such large amount of cash on their balance sheet, because the international bank regulation would penalize them. So what happened is that these mega banks, went to the Fed and say, hey guys, we need some help. You need to help us make these large deposits go away. So the Fed went back to an old instrument that they have, which is called the repo rate facility, to take their cash. And what they did is the Fed jacked up the overnight repo rate and tied it to the federal fund rate, and they used this process with the overnight repurchase agreement. So basically the Fed took all the cash that these mega banks didn't want to keep on their balance sheet, and we have now, through the reverse repo rate facility, more than $2.3 trillion sitting there. So the Fed took all the cash overnight, and we now have more than $2.3 trillion sitting there. So it served the purpose for mega banks, but it also created a problem for the small regional banks. They had to go out and they had to invest their cash surplus with low yield security and bonds. As these banks, these small regional banks, don't have access to the reverse repo facility, as the necessary requirement is that you need to be above $30 billion in total asset managed. So now depositors start to realize that they can also get higher yield and put their money in higher yield alternative investment. And we've seen now that there is $5.2 trillion accumulated in money market funds, which will continue to put pressure on short-term yield. Investors have pushed $66 billion in the last week of March to money market funds. So a ton of cash went into money market funds, and I think that this trend will continue. So we've seen the Fed continuing to increase rate, which makes the problem even more vicious. Smaller banks are more likely to be exposed to such risk. And the Secretary of Treasury, Janet Yellen, stated last week clearly that they cannot be there and bail out the entire banking sector and will be forced to pick and choose winners. And this is a statement that she made to a senator when he was asking specifically what she would do if some of the small and regional banks were to fail in his state. So big banks have the advantage of being perceived as being too big to fail, which indirectly implies that the Fed will always be there to bail them out. And as lending is tightening and banks are facing a major liquidity crisis, you can expect the Fed to start to put a pause on their high interest rate. So we may even see the Fed starting to pivot as there is a need to ease the market, and I hope that this will happen soon. But as you may know, it always takes 9 to 18 months for monetary policy to see an impact, a direct impact in the economy. So right now, we have seen the impact of the first rate hikes, maybe the second. But you have had 7 or 8 now rate hikes impacting the economy. So we haven't seen the impact of all the next 7 rate hikes. And this will take more time, but unfortunately, the market is now collapsing. We're seeing many banks being exposed to a credit crunch, and banks have stopped making loans, which is the way banks make money. So we are now in a situation that Keynes would describe market and the Fed have remained irrational longer than the market can potentially remain solvent. And that is precisely the issue that we will see with more bank runs, business filing for bankruptcy, and the economy getting weaker and weaker.